Well, good afternoon. Time to check in on the Friday edition of the markets. And as usual, we start off with things on the Asian side. Bit of a mixed performance this morning with Japanese markets returning to trade after a public holiday. Investors also taking a look to see if there are any signs of cooling inflation. However, we did get more Fed President comments, this time from the San Francisco Fed President Mary Daly, saying that inflation in the U.S. is still too high and that she is foreseeing more aggressive monetary policy going into 2023. However, her base case scenario going into the September meeting is another half a point hike. However, she is open to 75 basis points if it is necessary. Meanwhile, the rand at around 16.28, and like most emerging market currencies, it does get affected with a whole host of some of the global news that we do get out in relation, especially this time around, to the high inflation and high interest rate environment that we find ourselves in. Locally, when we look on SENS, we did get a statement coming out of the Takeover Regulations Panel giving telecoms operator Rain a dressing down after it proposed a 40 billion rand tie-up with Telkom. The TRP asking Rain to withdraw that statement, saying that they hadn't sought any prior approval. Meanwhile, Telkom also coming out and saying that they've received no formal offer from Rain, and if that is the case, they will be considering it and obviously take it to the board for the necessary discussions to take place. However, we will keep you updated as news around that particular tie-up do happen or not happen. We don't know. However, to give us perspective from a global markets point of view, we are joined by Lukman Otsunuga from FXTM. Lukman, thank you so much for your time. I mean, what would you describe as the global market sentiment right now, given what we're seeing on our screens in terms of the markets, and what themes are flowing through here?
Thank you very much for having me here today. Wishing you a happy Friday. We can see a sense of positivity across financial markets today with European equities and US futures in the green. It looks like markets seem to be welcoming a softer dollar, reduced Fed hike bets, and signs of inflation cooling in the largest economy in the world. I think earnings season has been far from perfect, but that's also supporting this risk-on mood we're seeing supporting equity markets across the globe. The key themes are still present, though. We've got growth fears, inflation concerns, and geopolitical tensions, but it looks like markets are taking in these short-term wins to push equities higher. But I think over the next week, over the next few months, the key themes still weighing on markets may limit upside gains.
On that note, then, what do you deem the recent U.S. inflation prints that we've seen to mean for the economy? I mean, the market quite excited when they saw that PPI figure.
So certainly, there's been, so we'll start with the CPI figure and PPI. CPI, the fact that it came in at 8.5% was a welcome development for markets, and it did, take some pressure off the Federal Reserve from coming too aggressive on rates. The same can be said with the PPI figures. We have to keep in mind that higher interest rates mean higher borrowing costs will result in people spending less, which feeds through the demand for goods and services. But the fact that inflation seems to be cooling in the largest economy in the world, this could support consumption, which remains an engine of growth. It doesn't change the fact that the elevated cost of living are still resulting in people using credit cards and eating into their savings. But overall, though, I think with the inflation figures we've seen from the States this week, it's fed into a sense of positivity of the outlook for the US economy. But ultimately, we are data dependent, and more information needs to be released, to come to a meaningful conclusion.
Given this rebound that we've seen since mid-July and talk of a possible Fed pivot, what conviction do you have of this rally that we're seeing and its ability to sustain itself?
And this is the hot topic and a hot question. U.S. equity bulls back in the picture. We've seen the S&P 500 up almost 13% since mid-June, and Nasdaq gaining, clawing back 20% gains. There's a lot of things that have been in play. The Fed hasn't been as aggressive as most anticipated. Back in July, when the Fed went ahead with its jumbo rate increase, Powell did sound less hawkish as most anticipated, and this has fueled a lot of chatter over the Fed stepping back on this aggressive approach towards rates. Moving forward, though, I think in the near term we may see equity markets, especially in the US, benefit from a softer dollar. The earnings season that wasn't as bad as most anticipated, and reduced bets over the Fed moving ahead of its aggressive rate path. However, though, we've still got concerns over global growth. We've still got, developments in China, geopolitical risks. So short to medium term, equity markets could push higher, but longer term, nothing much has changed.
Speaking of the dollar, I mean, given its performance, what signals are you taking from it as you evaluate other riskier assets?
Yeah, certainly. We're looking at the dollar. There's been three primary drivers behind the dollar's impressive appreciation for the first half of 2022. Number one, it's been interest rates. The Fed has been, at the top of the pack when it comes to raising interest rates. The second thing has been the health of the US economy. And the third has been the fact that the dollar seems a safe haven investment. But if you look at the dollar's performance month to date, the dollar's actually weakened against most G10 currencies. The reason is because, number one, people are dialing back on Fed rate hike bets. Number two, the US economy has experienced 2 consecutive quarters of contraction, fueling recession concerns. And number three, the overall market mood has been somewhat improving, removing that risk-off sentiment. I see the dollar possibly weakening further over the next few months. This should provide breathing room for G10 currencies to fight back, like the pound, the Australian US dollar, even the Japanese yen. But looking at commodities, I'll be paying a very close attention to gold. Gold punched above that 1800 psychological level today. With the way things are going, with the dollar continue to weaken, with the Fed stepping back on its approach towards rates, this could offer gold a potential to really break above that 1800 level over the next few weeks.
Before I let you go, going into next week, any key events or company announcements that you're going to be paying attention to?
Yes, certainly. It's a quiet week, where we are in holiday season. This is August. The markets in general are quiet, volatility data-wise. But for me in the UK, I'll be paying very, very close attention to the UK inflation, UK jobs data, and retail sales. Earlier today, it was confirmed that the UK economy actually has entered a contraction in the second quarter of 2022 by 0.1%, compared to the expansion we saw in the first quarter at 0.8%. Now, the UK is facing multiple headwinds. We've got, soaring inflation, which is at a 40-year high, a cautious central bank, political noise, which we haven't got a new prime minister yet, and post-Brexit related drama. So there's a lot on the table for the UK economy. So that's why I'll be paying close attention. Globally, we've got the FOMC meeting minutes. I think, it's the minutes, but it could offer fresh insight into what policymakers were thinking when they raised interest rates by 75 basis points last month. And if we have a new insight, this could shake markets.
All right, Lukman, let's leave it there. Thank you so much for your time. That is Lukman Otsinoga from FXTM, giving us his perspective on the markets. And of course, on Monday, we've got Japan's Q2 GDP figures, as well as Walmart earnings that are coming out on Tuesday. But we'll unpack all of those for you next week.